Okay, so today we're taking a deep dive into, well, let's be honest, a giant in the investing world, Rady. We've got a summary of Benjamin Graham's The Intelligent Investor.
Yeah, talk about a classic.
I mean, this book, it came out in 1949, and people still treat it like the holy grail of investing.
You know, Warren Buffett even called it by far the best book ever written on investing.
Yeah.
So that's got to count for something.
Right. So what we're going to do today is really mine this summary for the gold nuggets. We want to give our listeners like a fast track to understanding what intelligent investing is all about. We'll hit those core ideas like, the whole Mr. Market thing and that super important concept of margin of safety. Basically, we're going to equip you with the same tools used by some of the most successful investors to build wealth, real lasting wealth, and sidestep those common traps that can really trip you up.
Sounds good to me.
So let's dive in. Let's unpack what this whole intelligent investing approach really means.
All right, so right off the bat, what struck me about Graham's approach is how he defines an intelligent investor. It's not about, having some genius level IQ or knowing all the fancy algorithms. It's way more about character,
Oh, interesting. So what kind of character traits are we talking about?
He talks about patience, discipline, and a real desire to learn and keep learning.
Mm-hmm.
But the big ones, and he really hammers these home, are emotional control and independent thinking.
So it's not just about crunching numbers.
Exactly. You got to have the right mindset, that psychological edge to stick to your plan even when, the market's doing its crazy dance.
Which, let's be honest, is most of the time.
Yeah, pretty much. And that brings us to, I think, one of Graham's most fundamental points. The difference between investing and speculating.
Yeah, that's huge.
He's super clear about this. Investing, for him, means doing your homework.
Yeah.
Like really digging into what you're buying, your main goals. Safety, keeping your principal intact, and aiming for a decent return over time.
Okay, so that's investing. What about speculating?
Speculation. Well, that's when you're basically flying blind, making decisions without doing that hardcore research. And that, my friend, is a recipe for losing your shirt.
Makes sense. So where do we draw the line? How much speculating is too much?
Graham's pretty firm on this. He says if you absolutely got to scratch that speculative itch, keep it to a tiny part of your portfolio. He even calls it, get this, a mad money account. 10% tops. And keep it completely separate from your serious investment money.
So hey, if you want to gamble a little, go ahead. But don't mix it up with the money you're trying to build a future with.
Exactly. There's a great quote in the summary that sums this up perfectly. Be an intelligent investor. Understand the difference between investment and speculation. He's basically saying, don't just throw darts at a board. Think about your financial future, be smart about it, and don't fall for those get-rich-quick schemes. And this disciplined approach really ties into how you interact with, wait for it, Mr. Market.
Ah, yes, Mr. Market. Honestly, one of the most brilliant and enduring ways to wrap your head around how the stock market works. It can be so irrational sometimes.
It really can. So Graham, he personifies the market, right? He makes it this character, this guy, Mr. Market, who pops up at your door every single day. And every day, Mr. Market's offering to either buy your shares or sell you his.
I love this analogy.
The catch is, Mr. Market is kind of moody. His prices, they're all over the place, driven by emotions, not logic. Sometimes he's super optimistic. Other times he's totally doom and gloom. But here's the thing. Those emotions, they don't always or even often reflect what those companies he's peddling are really worth.
So as intelligent investors, we can't just take Mr. Market's word as gospel.
Absolutely not.
Well,
we only play ball when his prices line with our own homework, when his offer makes sense based on what we think a company is truly worth. Otherwise, we just tune him out, ignore the noise, let him have his tantrums.
Mr. Market, you're being ridiculous today. I'm going back to my spreadsheet.
You got it. And Graham is so sharp about this. He says that if you freak out, really panic, when the market takes a dip, especially when it's not justified by anything real, you're actually shooting yourself in the foot.
Yeah.
You're letting Mr. Market, with all his emotional baggage, control your moves.
It's like giving him the power to make your decisions for you.
Exactly. And that's the opposite of being an intelligent investor.
Mm.
There's a quote from the summary that really drives this home. The speculator's main interest is to anticipate and profit from fluctuations in the market. The investor's primary interest is to acquire and hold suitable securities at suitable prices. In other words, don't get caught up in the short-term game. Keep your eyes on the prize, long-term value.
So we pay attention to the stock price when it's in our favor, like when there's a bargain to be had or when the market's gone bonkers and is overpaying for something. Which brings us to, I think, the heart of Graham's approach, intrinsic value and this idea of a margin of safety.
Right on. Intrinsic value is like,
Yeah.
well, it's like a company's true north. It's what that business is actually worth, regardless of what the market's saying at any given moment.
Okay, so how do we figure that out?
It takes some digging. You got to analyze the company's fundamentals, its assets, earnings, its potential for growth. It's a deep dive, but it's how you find those hidden gems.
And then there's the margin of safety, right? This is like Graham's secret weapon.
This is the key. It means buying a stock for significantly less, like way less than your calculated intrinsic value.
So it's like building in a buffer zone, a safety net, just in case you made a mistake somewhere in your analysis or, some unforeseen event comes along and messes things up.
Exactly. It's like having a cushion. The summary even says that if you buy at a low enough price, even a so-so company can be a decent investment. It's all about that margin of safety. It's like Graham's way of saying, hey, nobody's perfect, so let's be prepared for when things don't go exactly as planned.
I like that. It's a very humble approach.
And smart. Graham's not all about putting all your eggs in one basket either. He's big on diversification, spreading your money across a bunch of undervalued companies.
Right. So even if one doesn't perform as well as expected, the others can pick up the slack.
Yep. And here's another gem from Graham. He says that the less your analysis relies on guessing what's going to happen in the future, and the more it's based on what's happening right now with the company financially, the less likely you are to make a big mistake.
Okay, so ground your analysis in reality. Don't get carried away with overly optimistic projections. I think I can handle that.
Good. Now, it's important to remember, intelligent investing isn't some get-rich-quick scheme.
No, definitely not.
It's about building wealth steadily over time. The long game.
Exactly. And I think that's a really important point for people to grasp. It's about slow and steady wins the race, not about chasing the latest fad.
Couldn't agree more. Graham, he emphasizes this idea of treating your investments like you own a piece of the business. It's not about flipping stocks like trading cards. You're buying a stake in a company, becoming a part owner. There's a great quote in the summary: stocks do well or poorly in the future because the businesses behind them do well or poorly, nothing more and nothing less. This means focusing on the fundamentals, how well the companies run, its long-term prospects, not just the daily ups and downs of the stock price.
So basically, be patient. Think long-term. Don't freak out over every little blip on the radar.
Exactly. Now, Graham also recognized that not everyone has the same amount of time or even interest in managing their investment. So he came up with two main types of intelligent investors: the defensive and the enterprising.
Okay, so tell me more about this. What's a defensive investor?
A defensive investor, they're all about protecting their money. They want decent returns, but with minimal effort and stress. This is perfect for people who are busy with their jobs, their families, life in general, and don't have the time or the desire to become investing gurus.
And what about the enterprising investor?
Well, the enterprising investor, they're a bit more hands-on. They're willing to put in the time, do the research to try and beat the market.
Sounds more like a full-time job.
It can be, but for some people, it's exhilarating. They love the challenge.
So Graham provides specific guidelines for each type, right? Like how to pick stocks, how to manage their portfolio.
He does. For the defensive investor, he lays out some pretty specific criteria. He says, look for solid companies, good size, not those tiny startups that can be here today, gone tomorrow. He really emphasizes financial strength, like make sure their assets outweigh their liabilities.
Right, they need to be able to pay their bills.
Exactly. And look for companies with a proven track record. Have they been making money consistently? Do they have a history of paying dividends? And don't get seduced by those flashy, high-priced stocks. Keep it moderate.
Sounds like a very sensible, low-risk approach.
It is. Graham recommends keeping it simple, too. Invest in a mix of high-quality bonds and stocks, maybe starting with a 50-50 split.
Okay, so that's the defensive playbook. What about the enterprising investor? They're probably doing things a bit differently.
They are. They're looking for those hidden gems, those undervalued companies with huge potential.
What are some clues they might look for?
Well, they're looking for companies with a competitive edge, something that sets them apart from the pack.
Like what?
It could be a unique product, a strong brand, maybe a really efficient way of doing business, and they pay close attention to the management team. Are they competent? Ethical? Do they have a vision for the future?
So it's about more than just the numbers.
It is. And of course, they're still looking for solid financials. Is the company growing, generating cash, paying dividends? All those things are important. But the enterprising investor is willing to dig a little deeper to find those companies the market might be overlooking. The summary even suggests looking at stocks near their 52-week lows as a potential starting point.
So bargain hunting, essentially. But not just any bargain. It has to be a good company that's temporarily out of favor.
Right. And figuring out a fair price for those enterprising investments, it takes a bit more work. You have to really analyze their earnings potential, value of their assets, their debt levels. It can get complex, but the core principle is still the same. Buy at a significant discount to your calculated intrinsic value. Always leave that margin of safety.
So no matter which type of investor you are, defensive or enterprising, Graham's message is clear. Do your homework.
Absolutely. He's all about thorough research. Check out the management team. Look beyond the hype. Analyze the financials. He even warns against companies that use tricky accounting to make themselves look better than they are.
Sneaky.
Yeah, you got to be careful. Look at the footnotes, he says. That's where the real story often hides.
Okay, so we've talked about analyzing the numbers, but investing is also about managing our own psychology, right? Our emotions can really get in the way.
This is where Graham gets really interesting. He was way ahead of his time in understanding the psychology of investing. He knew that our emotions can lead us to make bad decisions, selling in a panic when the market dips, or getting caught up in the frenzy and buying when prices are sky high.
We've all been there.
Right. So Graham says the key is to be aware of our emotions, to cultivate that self-control. Don't let fear or greed drive your choices. Stick to your plan. He even talks about the money illusion, thinking you're making money when you're really just keeping pace with inflation.
So invest to grow your purchasing power, not just to see bigger numbers on your account statement.
Exactly. And it's crucial to know your own risk tolerance. How much can you handle financially and emotionally? Knowing this will help you avoid those impulsive decisions that can really cost you.
So to sum it all up, value investing, the way Graham laid it out in The Intelligent Investor, is a proven approach to building wealth over time. It takes work. You got to be willing to do your research, be patient, and have the discipline to stick to your principles.
Couldn't have said it better myself. And for folks who maybe don't have the time or the expertise to pick individual stocks, Graham suggests looking into mutual funds that follow a value investing approach. They offer diversification and professional management, all while sticking to those core principles.
So to wrap up our deep dive into The Intelligent Investor, we've covered a lot of ground.
The difference between investing and speculating, the importance of understanding Mr. Market's moods without letting him control your decisions, the absolute necessity of a margin of safety when calculating intrinsic value, the different approaches for defensive and enterprising investors, the need for thorough research, and maybe most importantly, the need to keep our emotions in check.
And I think the biggest takeaway from The Intelligent Investor is that success isn't about timing the market perfectly or becoming some kind of stock-picking genius. It's about understanding yourself, having the discipline to stick to a plan, and applying those timeless principles of value investing.
Well said. You know, The Intelligent Investor, it really is like the Bible of investing. It stood the test of time for a reason. So for our listeners, I challenge you to think about which type of investor you are, defensive or enterprising, and how you can use these principles, these tools that Graham gave us, to build your own financial future. Maybe in our next deep dive, we can explore some practical methods for calculating intrinsic value. That's a whole other rabbit hole. Thanks for joining us today.
Always a pleasure.